Good morning, everybody. Welcome to class this morning. We shall be continuing to study other standards this morning after we are done with the group accounts. So please, I want to encourage you to make sure you watch the videos, the 12 videos we have on group accounts, and make sure you understand them very well and practice them well, because you can't avoid group accounts in your examination. Please treat past questions on group accounts sufficiently. It will be a booster to your mark in examination. So this morning we will be studying IFRS 13, fair value measurement. IFRS 13, fair value measurement, provides guidance on how the fair value of assets and liabilities should be determined. That is, price is what you pay, while value is what you get. That's the quotation for these. So the most important thing is that this standard tells us how to determine the fair value. You know, the word fair value is common in financial reporting and corporate reporting. We have mentioned the issues of fair value under IAS 16, IAS 40, IFRS 9, and several other standards that talks about fair value. That word is rampant. But how do we determine the fair value of an asset and liability? This standard talks specifically about that. So quickly we look at the various definitions under this standard. Number one, fair value. What is fair value? This is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. The price that will be received to sell an asset or the price that will be paid to transfer a liability in an orderly transaction between market participants at the measurement date. IFRS 13 based its fair value definition on exit price. Exit price. So there is what we call an exit price and there's what we call an entry price. The price that will be received to sell an asset and the price that will be paid to transfer a liability is what we call fair value. So let's look at the definition of exit price. When we say exit price, this is the amount or price that will be received to sell an asset or paid to transfer a liability. So I want to explain that to us. And okay, let's define entry price so that I can explain the two from the perspective that is clear to us. Entry price, this is the amount or price that would be paid or incurred to acquire an asset or cash or other asset received in exchange that will be received in exchange for a liability, that is to receive, to incur the liability. So let's assume you have a phone in your hand, and that phone, you want to sell it. You bought it initially for use. It's not an inventory. I'm talking to you as an individual now. You bought it for use. If you want to sell that phone in the market, the price you can receive when you offer it for sale is what we refer to as fair value. It's the exit price. You had it before, you want to avoid having the phone, and you want somebody to pay for it. The amount you can receive is the exit price. Whereas if there is a phone you like to have, but you don't have, the amount you will pay to get that phone is an entry price. The price that will be paid to or incurred to acquire an asset. That's an entry price. Okay, for liability as well. You want to be discharged of a liability. You have a liability on your head, but you want to transfer that obligation to somebody else. The amount you must pay for you to transfer your obligation to someone else is an exit price. Whereas the amount you will collect to incur a liability, to have an obligation on your head, the amount you will pay, the amount you will receive might be in form of a loan, it might be in form of a benefit, that is a car that is given to you and that places an obligation on you that you must pay. The amount you receive to incur a liability is an exit price. It's an exit price. It's an entry price, sorry. The amount you receive to incur a liability is an entry price. But the amount you will pay to transfer the liability off your neck is an exit price. So fair value, IFRS 13, and the fair value you'll be hearing about in all standards that is talking about fair value is an exit price, not an entry price. So another definition, market participants. These are independent buyers and sellers who are informed, willing, and able to enter into business transactions. The people that know about the business of the asset or liability we are talking about. The people that have detailed knowledge about the asset and liabilities we are talking about. They are the ones we refer to as market participants. They might be buyers, they might be sellers. Not people who don't have information relating to that asset. For instance, I normally use an example of Computer Village here in Lagos when I want to talk about market participants. People in Computer Village, especially those who deal in phones, know in and out of phones. The moment they see it in your hand, they can tell you the condition that the phone, even if you are buying the phone anew, they will tell you the problem the phone will have when it starts having problem. They know how much that phone is in the market. They know how much is the new one. They know how much is the used one. And they know how to check if the use has gone to a particular extent, if it has diminished. So if you want to determine the fair value of a phone, for instance, now a phone you are using, you want to determine its fair value, go to Computer Village. They will tell you how much they will pay you. And there is a difference between entry and exit price. If you go to Computer Village, for instance, you want to buy a phone for the first time, whether it's a new phone or a used phone, that's an entry price. The amount they will charge you to buy that phone is different from the amount they will offer you if you are the one that brought that kind of used phone to the market. So entry price is always higher than exit price. Entry price is always higher than exit price. So it is exit price we use in fair value, and market participants are persons who have detailed information and look at their qualities. They are informed, they are knowledgeable. That's what it means. They are willing, not that you are forcing them to determine what the price is. They are willing to determine, to talk about the price of the asset, and they are able. You can see those three qualities of market participant. They are informed, they know about it, they are willing to enter into that transactions, and they are able to enter. Ability has to do with financial capacity. Do they have the means of actually negotiating the price? Do they have the means to buy it? Are they able? So if those three qualities are not there, the persons we are talking about are not market participants. Next, we go to measurement date. This is the date that transactions took place between market participants. So you can now see the definition of our fair value, how it is derived. It is the price that will be received to sell an asset or pay to transfer a liability. That is, it is exit price. In an orderly transaction, we'll be defining orderly transactions between market participants. Who are market participants? People who are knowledgeable about this asset and liability. At a measurement day, what's measurement day? The date that the transaction took place between market participants. Then we go on to defining what an active market is. An active market is it's a term we are going to be using inside this in this standard. So active market, these are the most advantageous or principal market of an asset. It's what we call an active market. The most advantageous and or a principal market. The most advantageous or principal market of an asset is what we refer to as an active market. This is a market in which transactions for the asset or liability take place with sufficient frequency and volume to provide pricing information on an ongoing basis. For instance, for financial assets and financial liabilities, the active market is usually the stock exchange market. For public listed companies, if you want to determine the price of a particular share, if the company is a public listed company, just go to the stock exchange market, you'll see the price there. And that is an active market where, so it can be a principal market if that kind of asset is treated with a volume. You'll be seeing the definition of principal market shortly, and that most advantageous. So those are the two markets we call active market, most advantageous or principal market. So let's look at what's a principal market. This is a market where the greatest volume and level of activity for an asset takes place in an orderly transaction. The market where the greatest volume and level of activity for an asset takes place in an orderly transaction. So if they give you an examination question and they try to ask you to determine an active market, or whether it's a principal market or most advantageous market, these are the qualities you should look out for in determining them. Under this market, that is the principal market, the fair value of an asset is the amount that will be received to sell the asset less its transportation cost. Determining the fair value in a principal market is what? The fair value minus transportation cost. Transaction costs are ignored as they are not characteristics of the asset. When an entity wants to determine the fair value of an asset, it is not because they want to sell that asset. No. In most cases, they want to know what value they should recognize the assets in their financial statement. So transaction costs are costs that are incurred that are directly attributable to transactions. But when the transactions will not be taking place, there will be no need to include it as in measuring the fair value. Then we have most advantageous market. The most advantageous market is the market that maximizes the net amount that will be received to sell an asset. So if there is principal market, that is where to sell. But in the absence of principal market, then we have the most advantageous market. The market that maximizes the net amount that will be received to sell an asset. That is the selling price of an asset less its transaction cost, and transport cost. Although the transaction cost is taken into consideration when determining the most advantageous market, the transaction cost in determining the most advantageous market, but in determining the fair value of the asset, the transaction cost will be ignored. You will be seeing it when we want to do our calculations. Next, we have transaction cost. What's transaction cost? These are costs incurred in acquiring an asset or in settling liability. In settling a liability. You want to settle a liability, the cost you incur. These costs are directly attributable. Example, agent fee, commissions, and the broker fee, charges, all of those things we pay for commissions. We treated these issues of transaction cost under financial instrument Ifrs 9. We also treated the issue of transaction cost when we were dealing with Ifrs 15. So please, when we talk about the relationship between principal and agent, the commission that is paid to an agent is a transaction cost. And you don't forget that the principal will account for it as an operating expense in its financial statement. So we have another concept, observable inputs. These are inputs that are developed using market data, such as publicly available information about actual events or transactions, which reflect the assumptions that market participants will use when pricing the assets or liabilities. The assumptions that market participants will use, the inputs, that information that's available publicly in the market regarding the asset or liability. We have unobservable inputs. These are inputs for which market data are not available, but are developed using the best information available about the assumptions that market participants would use when pricing the asset. So we go on to the basis of a fair value measurement. What is the basis of a fair value measurement? We need to pay attention to this. This basis for measuring fair value is commonly referred to as an exit price. That's what I said earlier. The basis is what is referred to as an exit price. An exit price approach because it reflects the price at which a market participant that holds the asset or holds the liability could exit the asset or liability by selling the asset or transferring the liability to a third party. Fair value, as defined above, is a market-based measurement, not an entity-specific value. It is the market that determines the fair value. It is therefore measured using the assumption that market participants would use when pricing the asset or liability, including assumptions about risk. Consequently, an entity's intention to hold an asset or settle or otherwise fulfill a liability is not relevant when measuring. So assumptions of the intention of the entity is not relevant. It is the assumption that market participants would use that is relevant in determining fair value of an asset or that of a liability. So we move on to what we call orderly transaction. Orderly transaction. This is a transaction that provides adequate exposure considered usual to the market participants before the measurement date. The transaction that provides adequate exposure. We are not trying to have a forced transaction. That is, the market participants don't know what is happening in the market. Because, for instance, in the stock exchange market, when you are dealing with financial instruments, prices change. You can buy a share in the morning and the price has gone up in the afternoon. Or you can buy in the morning and the price has gone down. So, an orderly transaction is where we determine fair value from. And this is a transaction that provides adequate exposure considered usual. The kind of exposure considered usual to market participants. According to Ifrs 13, the following are not orderly transactions. Transactions that are not orderly transactions. One, a transaction under duress is not an orderly transaction. Somebody is just forced, maybe the person is broke, he wants to sell the shares, or there is a problem somewhere, the tension is there, or the tension is to ensure the liability is there. That's not an orderly transaction. Two, a forced transaction, that is maybe through a distress sales or forced liquidation. When the company is broke, they need to pay their liabilities, they are trying to dispose what they have. That's not an orderly transaction. That's a transaction that is forced. A transaction that the seller is in or near bankruptcy or receivership, that is, the person is broke, the company that wants to sell this asset or incur this liability, that under tension to do so. It's not that they are willing, but there are conditions that makes it so unfavorable for them to incur the liability or to acquire the asset. That is not an orderly transaction. A transaction that the price is out of proportion, that the price is out of proportion when compared to prices of similar assets. That's not an orderly transaction. That's talking about related party transaction. Something is supposed to be sold for 1 million, but because I know you, you know me, I sell it for 650,000. That's not an orderly transaction. It's not an orderly transaction. A transaction that the seller was required to sell in order to meet legal or statutory requirement. Legal or statutory requirement. That is not an orderly transaction. A transaction that did not provide adequate exposure considered usual or for such asset or liability to the market participant. That is, the market participant does not have time to know what is happening in the market. That's not an orderly transaction. A transaction that provided adequate exposure considered usual and customary for such assets is what that provides adequate exposure is what we refer to as fair value. Adequate exposure is an orderly transaction. The one that provided adequate exposure considered usual and customary for the asset and liability is an orderly transaction. So let's move on with our notes. Who are market participants? Market participants are defined as buyers and sellers in the principal market or most advantageous market for the asset and liability. For the asset or liability. Market participants are expected to have all of the following characteristics. I mentioned it earlier. They are independent, so they can't be forced to do a thing. They have the right to make their decisions, and their decisions stand. They accept responsibility for their decisions. They are knowledgeable, that is, they know what they are doing. They are informed about the condition of the market. Those are market participants, having a reasonable understanding about the assets or liability. Next, they are able to enter into a transaction for the asset or liability. Those are market participants. They are willing to enter into a transaction for the assets and liability. So they are independent, they are knowledgeable, they are able, and they are willing. Those are the characteristics of market participants. In case you are asked in examination to define who market participants are, don't forget these 4 characteristics of market participants. They are independent, they are knowledgeable, they are able, and they are willing. So the measurement date is the day that the fair value of an asset or liability is determined. That is the date the price to sell the asset, the said asset, was ascertained, or the date to pay for the liability, the date to pay the said liability. Sorry, the date to pay for the said liability. That's the day that day was ascertained, the measuring day. The market in which the fair value will be determined. Where do we determine the market? Where do we determine fair value? This is a common question in examination, so please pay attention. IFRS 13 requires an entity to consider the market in which the sale of an asset or transfer a liability will take place. According to Ifrs 13, the fair value of an asset or liability should be determined in the principal market for the asset and the liability. So please, that is where to determine the fair value. But they say, however, where there is no principal market, then the fair value of an asset or liability should be determined in the most advantageous market. We have defined these 2 earlier. Of course, when we want to start doing our workings, you will see how they are also determined. When we want to do our workings, you see how they are determined. So that's it. So for instance, a principal market may not exist when the volume or level of activity for the assets or liability is the same in 2 different markets to which the entity has access, or when there is no observable market for the assets or liability. So when that is absent, then you use the most advantageous market. But when there is access to principal market, you determine your fair value in the principal market. Then we talk about transaction costs. Transaction costs are the directly attributable costs incurred to sell an asset or transfer a liability in the principal or most advantageous market for the asset or liability. So when we talk about transaction costs, I mentioned the definition earlier. They are costs attributable to selling. They are expected to meet the following 2 criteria. 1, they result directly from the transaction or are essential to the transaction. 2, they would not have been incurred by the entity had the decision to sell the asset or transfer the liability not been made. That is, if the decision to sell has not been made, that transaction cost will not be determined. Will not have occurred in the first place. Those are the qualities of transaction cost. According to Ifrs 13, the transaction cost should not be considered in deriving the fair value of asset or liability. You use them in determining where the most advantageous market is, but when you want to determine the fair value of asset or liability, you don't consider transaction cost. This is because transaction cost is not characteristic of the asset or liability, but is specific to a transaction which will differ depending on how an entity enters into a transaction for an asset or liability. Then we have what we call transport cost. Transport costs are the costs that would be incurred to transport an asset from its current location to its principal or most advantageous market. Transport costs should be deducted in deriving the fair value of asset or liability, either in the principal market or most advantageous market. So we have principal market and most advantageous market. We defined it earlier, but let's see them in more detail under this section. The principal market and the most advantageous market. We can see them in details under this section. Principal market is the market where the greatest volume and level of activity for an asset takes place in an orderly transaction. Under this market, the fair value of an asset is the amount that will be received from the sale of the asset less its transport cost. Transaction costs are ignored as they are not characteristic of the asset. That's it. Principal market is the market where the greatest volume and level of activity for the asset takes place in an orderly transaction. So they give you two markets. You look at the two markets and see the one that has the highest volume of transaction. That's the principal market. And the measuring fair value, you should determine your fair value using the principal market. It's only when there is absence of principal market, maybe the two markets have the same level of activity, you want to determine the most advantageous market. That's when you use the most advantageous market. Most advantageous market is the market that maximizes the net amount that will be received to sell an asset. That is the selling price of an asset less its transaction cost and transport cost. Although the transaction cost is taken into consideration when determining the most advantageous market, but in determining the fair value of the asset, the transaction cost will be ignored. You'll be seeing that in calculation as we move on. Then we have the concept of what we call the highest and best use. This is what is used for non-financial assets. Financial assets are assets that are convertible to cash easily, whether what we call financial instrument. Financial asset can be a debt, financial asset, investment into debt instrument of another entity. It can be an equity financial asset. That is investment into the equity shares of another entity. And trade receivable, payables, all those are financial assets. But the one we call non-financial assets are tangible assets, or also can be an intangible asset, like land, buildings, motor vehicles, plant and machinery, all of those PPE, or intangible assets like brand, like all of those trademark, you know them. Those are non-financial assets. So the concept of highest and best use is used in determining the fair value of non-financial asset. The highest and best of a non-financial asset is the use of a non-financial asset by market participant that would maximize the value of the asset or the group of assets and liabilities, e.g., the business, within which the asset would be used. So how do we mean? For instance, we have a car. We want to determine the highest and best use of that car in determining its fair value. This car, for instance, maybe our MD has been using the car, and the MD is complaining that this car is making one funny noise. Or you just feel, okay, how do we determine the fair value of this asset? We try to look at the value we derive from the car if the MD is using it, and the value we can derive if for an alternative use. For instance, maybe when the car is being used as for these taxis, like Uber, Bolt, all of those things, what value do we place on the asset? So for us to determine the fair value of the highest and best use of an asset, we try to do it's usually done for asset that has alternative use. For instance, a plot of land can be used to build a shopping mall for marketing purpose, or can be used to build a house for residential purpose. So we determine the ones that brings in more value, and the way we measure that fair value, we will study it shortly. Simply put, it is the use of the non-financial asset by a market participant that will generate maximum benefits from the asset or group of assets or liability, e.g., business. So we have a way of determining the highest and best use of the non-financial asset. The following must be considered. Number one, physically possible. To determine the alternative use of an asset, we need to know whether the asset can be used, if it is physically possible to use the asset for that purpose. That is, it is possible. For instance, when we talk about land, is it physically possible that we use the land for the residential purpose? Or is it physically possible that we use the land to build a shopping mall or market purpose? Legally permissible. Does the law of the land allow that we use the land for that purpose? Or does the law of the land allow that we use the car for this alternative purpose we are thinking about? That is, this has to do with legal restrictions, if any, on the use of the asset that market participants would consider when pricing the asset. That is, if I buy the asset now as it is, can I use it for alternative? That is, this car is no longer being used for private. Can I use it for transportation? Does it have alternative use if I don't want to use it for the purpose? Or you want me to come and buy this land? I look at the land. Okay, maybe what you have on the land is a residential apartment. You want to sell the land. And I begin to look at the alternative uses. If I decide to build a shopping mall on this land, first, is it physically possible? That is, by the location of the land, if I build shopping mall on it, shopping complex, will people buy it? Will people patronize me? Will I get tenants to rent it? Or if it's a shopping mall that is there and I decided to say, okay, if I buy this land now, and maybe the shopping mall is not selling, is it physically possible? And is it legally permissible by law that I can build a shopping complex? Or if it's a shopping complex, something that is there, I can bulldoze it and build a residential apartment. So we need to look at the physical possibility of the alternative use and the legal permissibility of the alternative use. The third one is financially feasible. This has to do with the ability of the non-financial asset, ability of the non-financial asset of the non-financial asset that is physically possible and legally permissible to generate adequate investment return that market participants would require from an investment in that asset, put to that use. That is, I want to switch the use of this land from a market use to residential use. First, I must consider whether it is physically possible to do it for alternative use. Secondly, I must consider whether it is legally permissible, that is, the law allows it. Then, third consideration can then be useful. Don't forget that a land or a non-financial asset might have an alternative use that brings in more money than what is being used for now. That is why this financial feasibility is not put first, it's put last. The first thing is the physical possibility. Is it possible to use this non-financial asset for this alternative use? Then you consider legal permissibility, whether it is legally permissible. It is after these two criteria have been met that the financial feasibility is put into consideration. That is, will it bring in more money? So for the purposes of the last point above, the income or cash producing the investment return should consider the cost of converting the asset to that use. So we put cost of converting the asset to that alternative use into consideration when we want to determine the financial feasibility. There are examples that we'll be treating in the question today that you will see. So let's have the first example. It's a past question in ICANN on fair value. The ones you are likely to see in your examination. The ones you are likely to see in your examination. So I want to take the question to our worksheet where we'll work on it, you will see how calculations should be done on fair value. We'll be learning how to determine the active market, and then we'll be learning at the same time how to determine the most advantageous market, and we'll be learning how to determine the fair value of an asset. So I'll be taking us from here to our worksheet. I want to take this question to worksheet. So let me first take us to the worksheet where we'll work on this question. Then I will bring the question into the worksheet. I'll bring the question to the worksheet. So here we are. So let me try as much as I can to zoom this question for us to see clearly. This is an icon past question. Prior to the advent of IFRS 13, many standards such as IAS 16, IAS 38, IAS 40, and IAS 39, among others, require the use of fair value. These various requirements have been harmonized with the introduction of IFRS 13, fair value measurement. Required, define fair value in accordance to IFRS 13. This question carries 2 marks, so I will take you directly to the answer, and you can take your notes and write it down. I will take you directly to the answer based on what we have studied so far. So let me take you back to the slide. You are required to define fair value according to IFRS 9. This is the answer you will give them here. According to IFRS 13, fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. IFRS 13 bases its fair value definition on exit price and on entry price. That is, it bases fair value definition on exit price and entry price, and it must be market based, not entity based. So, but exit price is what we use in determining fair value. You can just add that to it. The fair value is measured based on exit price, and anything you can, this additional thing you can add to the fair value, the basis of measuring fair value. You can just add it to that explanation after saying that the fair value is a price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measuring date. You can then come and say that the basis for measuring fair value, that is, the basis for measuring fair value is commonly referred to as an exit price approach because it reflects the price at which the market participant that holds the asset or holds the liability could exit the asset or liability by selling the asset or transferring the liability to a third party. So price that will be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants on a measurement date is what we refer to as fair value. That's the answer to that question that we just saw now. So let's go back to the question. Now we are back to the question. So we have been able to answer this question number A, or question number 4A. Now, B. It said, one of the companies formerly operating in Nigeria that had recently relocated its operation to Ghana as a result of the challenging business environment in Nigeria has access to both Lagos and Accra market for its product. The product sells at slightly different prices in Naira in the two active markets. An entity enters into transaction in both markets and can sell the price and can access the price in those markets for the product at the measurement date as follows. Lagos market, you can see the price, the selling price in Lagos market is 260. The selling price in Accra market is 250. Transaction cost. The transaction cost in Lagos market is 30 naira and it's 10 naira in Accra market. Transportation cost. The transportation cost is 20 naira in Lagos market and 20 naira in Accra market. Net price receipt. After the cost is deducted from the price, they have this net price receipt. So we go required. 1. Briefly explain principal market of an asset in accordance with IFRS 13 and determine what fair value would be used to measure the sale of the above product if Lagos market were the principal market. Fine. Definition of principal market. Because we said briefly explain the principal market of an asset. Let me take us back to our slide where you see the definition of principal market again, in case you have this question in your examination. Principal market. This is the market where the greatest volume and level of activity for an asset takes place in an orderly transaction. That is the market where the greatest volume of an asset takes place, where they sell the most. So in examination, they can give you two markets and tell you the volume of transactions that takes place in each market. The one that has the highest volume, they can give you two markets, they can give you three markets. If you look at the volume of transactions, in this question we are filling now, the two markets they gave us, they didn't give us volume. But they are telling us specifically that Lagos, if Lagos is the market, is the principal market. But usually they may not tell you what is the principal market. They will just tell you the volume of transactions that take place in each market. So market that has the greatest volume and level of activity for an asset in an orderly transaction is what we refer to as what? Principal market. Under this market, the fair value of an asset is the amount that will be received from the sale of the asset less its transport cost. Transaction costs are ignored. The transaction costs are ignored as they are not characteristics of the asset. So you can see a further question says we should determine the fair value of the asset. You can see what we are going to be working at now. So this is what you are supposed to write for them if that kind of question occurs. This is the market where the greatest volume and level of activity for an asset takes place in an orderly transaction. And under this market, the fair value of an asset is the amount that will be received from the sale of the asset less its transport cost. Transaction costs are ignored as they are not characteristic of the asset. So let's go back to the worksheet and answer that question satisfactorily the way they expect us to answer the question. So now they said, and determine what the fair value would be, what fair value would be used to measure the sale of the above product if Lagos market were the principal market. So if they have told us, because they didn't show us the volume of transaction both in Lagos and Accra, but they said if Lagos were the principal market, how much would they sell this asset? So I want to have the solution here. Solution to this question. The solution to this question here. So if Lagos were the principal market, then let's have the Naira value here, Naira sign here. And then we have, what's the selling price? We want to determine the fair value of this asset. Selling price, that is sale price. The sale price in Lagos market is how much? The sale price, okay, the amount is rounded to the nearest 1,000. So let me round it to the nearest 1,000. The sales price in Lagos market in this question is 260,000. So 260. 260, that's the sale price. 260. Then the only thing we will be deducting is the transport cost. Transaction costs are ignored. That's what the definition says. So the only cost we will deduct to determine fair value is the transport cost, which is 20 naira. Transaction cost of 30 naira is going to be ignored. So therefore, we say transport cost. Transport cost. Transport cost is what? Let's look at it again. Is 20 naira. So therefore, we come here and say less transport cost, which is 20 naira minus 20. These are the only factors we are going to put into consideration. So what's the fair value of this asset now? The fair value of this asset is 240 naira. 240,000 naira. Sorry. 240,000 naira is the fair value. So this is the fair value. So how do you derive fair value? Fair value is usually the sale price, which is the fair value, less transport cost, whether in the principal market or in the most advantageous market. But in determining the most advantageous market, we put transaction cost into consideration. So we have been able to measure the fair value of this asset now, which is what? The sale price less transport cost. So the fair value of this asset is 240,000 naira. Let's continue to answer the question. You can see that thing we did is 4 marks. We have been able to get 4 marks just by doing that little calculation. How is the fair value determined in the absence of a principal market? And what fair value will be used to measure the sale of the above product if no principal market is identified? Now, in the absence of principal market, the most advantageous market is where we measure fair value. Let me take you to where the explanation is in this. I want you to get this. These questions are simple, but if you don't understand the basis for it, you might not know what to write. The most advantageous market. Now, let's go to where they said the market in which fair value will be determined. Ifrs 13 requires an entity to consider the market in which the fair value of an asset or transfer liability will take place. According to Ifrs 13, the fair value of an asset or liability should be determined in the principal market for the asset and liability. If there is principal market, that is where the fair value is. So when they say assuming Lagos is the principal market, the fair value will be determined in the principal market. They now said, however, where there is no principal market, then the fair value of an asset or liability should be determined in the most advantageous market. For instance, okay, we have talked about that. So this is it now. What we are expected to say there, when they say in the absence of a principal market, when the question says, if no principal market exists in respect of this asset, the question says, you can see the question, how is the fair value determined in the absence of principal market? The answer is the fair value is determined in the most advantageous market when principal market is not available. And in determining the most advantageous market is the market where we have the highest net price received after transportation and transaction costs have been taken into consideration. So if you look at these two markets now, you can see Lagos market has a net price received of 210 and Accra market has a net price received of 220. If there is no principal market, then we will go and measure the fair value in the most advantageous market, the one that has the highest net price received after deducting transportation costs. So Accra market is the most advantageous market. However, in measuring, so we have been able to determine the most advantageous market by deducting the transaction cost and transportation cost. So this is it, the most advantageous. We don't need to calculate it again. They have done it there. Accra market is the most advantageous. However, in determining the fair value, because the question further said, and what would fair value, so what fair value will be used to measure the sale of the above product if no principal market exists? The fair value that will be used in the Accra market will be the sale price, Naira rounded to the nearest thousand. Sale price, which is how much here? 250. less transportation cost, less transport cost, which is what? 20 naira minus 20. In determining fair value, you deduct only the transportation cost. However, in determining the most advantageous market, you must deduct the transaction cost in determining the most advantageous market. But after you have determined the most advantageous market, the fair value is determined without putting transaction costs into consideration. So this is the fair value of the asset if there is no principal market. This becomes the fair value of the asset in the absence of a principal market. But when there is principal market and we know the principal market, we will pick the price in the principal market, less transport cost also, and determine the fair value. You can see we have two different answers on two different questions. You can see 4 marks for each. That's 8. Interruption. Sorry for that short interruption due to network. If you can define fair value and you can do this little calculation, you have got 10 marks. That's as simple as fair value is. Then we have part C of this question, which seems to be it's 10 marks also, and we need to understand it. They are testing our knowledge of the highest and best use. Medical PLC, a public limited liability company, has just acquired some hectares of land in Abuja, earmarked by government for economic empowerment program of citizens, given the harsh economic environment in Nigeria, and so is only meant for commercial purpose. That land is meant for commercial purpose. The hectare of land they just bought. For the fair value of the land, the fair value of the land, if used for commercial purpose, is 100 million. So let's try to answer this question. I want to be extracting relevant information. We want to answer part C of the question. We have answered part B of that question. That is B1 and B2 has been answered. This is B1. This is B1. B1 has been answered, and this is B2 of the question. B2 of the question. We have answered B2 of the question. Now we are on question C. So I want to extract relevant information. For commercial purpose, they said if the land is used for commercial purpose, its fair value is 100 million. So let's put it here. So we are going to have to column commercial purpose. Sorry. Just make this, let's see capital letter. Commercial purpose. Commercial purpose. And so the fair value in naira, let me round it to the nearest thousand, 100 million. So I'm going to put fair value 100,000 now. 100,000. Since I've rounded it to the nearest thousand, that's 100 million for fair value. Let's continue reading the question. So they now said, if the land is used for commercial purpose, it is expected that it will result in reducing unemployment. This will attract a tax credit annually, which is based upon the lower of 15% of the fair value of the land, or 10 million naira at the tax rate. The current tax rate as fixed by government is 20%. So what they are saying is, if you use the land, so we can see now, the legally permissible and physically possible under the highest and best use we talked about earlier. Legally permissible and physically possible for this land is commercial purpose. It is legally permissible for market because they are marked it for commercial purpose. So that is legally, it's physically possible and legally permissible. The fair value is this. We are now looking at the financial feasibility. This is an additional cash flow for the company. If you use it for commercial purpose, you will get an additional inflow, which is tax credit, 20% of either 15% of the fair value or 10 million. So we first look at which one is the lower. 15% of the fair value is 15 million. 10 million is lower than 15 million, because if you look at it, this will attract a tax credit annually, which is based upon the lower of 15% of the fair market value, which is 15% of 100 million. That will give us 15 million. Or 10 million, the lower of, which one is lower? 10 million is lower. So we'll be working with 20% of 10 million as the tax credit. It will be treated as an inflow of cash. So we come here and say tax credit. Tax credit. The tax credit that the company will get is going to be what? Equals to 20% times 10 million, 10,000. Since I've rounded it, we have it here. This is tax credit that the company will get if they use it for commercial purpose. The addition of these two, therefore, will be measured as the fair value of this hand, because it fulfills the two obligations. The three obligations have been fulfilled: physically possible, legally permissible, and commercial feasibility. So we call this. So we want to know if there is an alternative use, because we want to compare two uses that the land can be put to. The two uses that the land can be put to will determine the alternative use of that land, if there is. So let's read the question. Let's continue to read the question. So that's the first use. The second use, medical PSA has determined that given the nature of Abuja's land, market participants would consider that it could have an alternative use for residential purposes. The fair value of the land, the fair value of the land medical PSA has just acquired for residential purposes before associated costs is estimated at 148 million. So let's extract the information for residential purpose. We have done this for what? For commercial purpose. So let's have residential purpose here. Residential purpose. For residential purpose, we want to measure the fair value of this land. So we have our Naira sign here also. We want to compare the two. So our Naira sign is there. They say fair value. Fair value is 148 million, 148,000. Since I've rounded it to the nearest thousand, so 148 million is 148,000. That's what it is here. So let's continue to read the question. This question is 10 marks. We are just extracting the information and measuring it. 148 million. In order to transfer the land from its commercial purpose to residential use, there is estimated legal cost of 4 million naira. We must include that. We want to make the legal, that will be change of ownership or whatever. So legal cost, 4 million naira. So minus 4,000. Since I've rounded to the nearest thousand, 4 million becomes 4,000. The legal cost. So we continue again. The legal cost has been put in. We are trying to measure the fair value. A project viability analysis cost of 6 million. So project viability analysis. These are costs that it will incur for residential purpose. Viability analysis. The viability analysis is how much? 6 million or so. Let me check it again. Viability cost is 6 million, so minus 6,000. We put it there also. Minus 6,000. Since we have rounded the 6 million and we have rounded the nearest thousand, we are using 6,000 at least. These are costs attributable for commercial purpose. Then we continue. And cost of demolition of the commercial building. There was a building on it before. We have to demolish the building. If we want to build residential building on it, it will cost us 2 million naira to demolish the building. So let's start cost of demolition. demolition, demolition. Demolition, 2 million minus 2,000. Then, to demolish the building is 2,000. Then, in addition, permission for residential use has not been formally given by Abuja Municipal. So it means it is physically possible to build this land, to build a residential building on this land. It is now becoming legally permissible because we can incur some legal costs and the government will approve it. But we have not got this approval. So they now said the permission has not been gotten. This has created uncertainty in the minds of market participants. Consequently, the market participants have indicated that the fair value of the land after the above cost would be discounted by 20% because of the risk of not obtaining planning permission from government. Additional, the reduction of 20% after deduction of this cost. So let's deduct this cost first. All of these costs, when deducted from this price, we are going to have 136 million. 136 million is what we have. They now said uncertainty cost, because we are not certain whether we will get the approval. Uncertainty cost is 20% of what we have here. That is equals to 20% times what we have here, the uncertainty cost. So uncertainty cost is estimated to be 27.2 million. I want to make it negative. So we want to look at the net amount that can be received. We have considered the legal cost, the viability analysis, the demolition cost, and then we have considered the uncertainty cost. The net amount that we can receive from this building is 108,800,000. So it means that it is physically possible to use that land for residential purpose. It is legally permissible because we have put in the legal cost and the uncertainty cost. We want to now look at the financial feasibility. Which of it, for commercial purpose, the financial returns we can get with the value we can get at most is 102. For residential purpose, the value we can get is 108. Which one has the highest financial feasibility? Don't forget, we are determining financial feasibility after we have taken the cost into consideration. That is the physical possibility, legally permissible. Now we are determining the financial feasibility, and we found that for residential use, the company has a higher financial feasibility. Therefore, the fair value of this land is going to be 108,800,000 because it produces the highest physical, legal, and financial feasibility. So the answer is 108,800,000. That is 108,800,000 is going to be the fair value of this land. This thing we have just done is 10 marks also. These few things we have just done now is 20 marks. You can imagine you get 20 marks straight like that on fair value. That's question on fair value. Let's continue. Let's go back to our slide and learn the other part of this standard, fair value. We go back to the slide. Ifrs Nashi, you are welcome. I think everybody now relies on video. They don't want to come to class. Anyway, we'll put the videos there. So now, we have been able to take that example. We can move on. This is the example we took. We now want to go to valuation techniques. Other parts of fair value measurement. These are techniques used in measuring the fair value of asset and liability when the price for the asset or the liability cannot be observed directly from the market. If we can't determine the price, the fair value from the market, you use what we call valuation techniques. That is, they are techniques used in measuring assets and liabilities that are directly quoted. the assets that are directly quoted. This is the techniques we use. So techniques used in measuring fair value are when the price for the asset cannot be observed directly. We can now use valuation techniques. IFRS 13 requires entity to use valuation techniques that are appropriate in the circumstances and for which sufficient data are available to measure fair value. This implies that entities are expected to maximize the use of relevant observable inputs. We defined this earlier, observable inputs, and to minimize the use of unobservable inputs. So we maximize the use of observable inputs in the valuation techniques and minimize the use of unobservable inputs. So inputs, we want to look at inputs to valuation techniques. These are the assumptions that market participation would use. That is, market participants, that's what it should be. The market participants would use when pricing the asset or liability. Inputs to valuation techniques may be observable or unobservable. So, let's move on. So we said types of valuation techniques, methods of valuing assets. According to IFRS 13, the following are the commonly used valuation techniques. 1, cost approach, that is sometimes refers to replacement cost, market approach, and income approach. These are the 3 approaches we use in valuation. Also, it's in SFM. When we talk about valuation in SFM, we use these 3 approaches for determining the value of a company in strategic financial management. So, cost approach. Cost approach is a valuation technique that reflects the amount that will be required currently to replace the service capacity of an asset. Usually, they use this cost approach for non-financial assets, that is, tangible assets. The cost approach also refers to current replacement cost. So if you want to use cost approach to determine the fair value, we say, okay, this car, if we don't want to use it again and we want to replace it, how much are we going to get it to determine the fair value of the car? The cost is often used to measure the fair value of tangible assets that are used in combination with other assets or with other assets and liability. Using the cost approach, the fair value of the asset is based on what it will cost a market participant, that's a buyer, or a buyer to buy or construct a substitute or similar asset. How much will it cost them to replace the asset? That's the cost approach. So we go to the market approach. Market approach is a valuation technique that uses prices and other relevant information generated by market participants, transactions involving identical or comparable assets. So if this asset is available in the market and we want to know an asset that is identical to it, for instance, a company that is a public listed company is into a particular product. Okay, let me just look for a common example. Okay, let's say a company produces cement, but that company is a private company. It's not registered, it's not listed on the stock exchange market. And Dangote also produces cement, but this time Dangote is a public listed company. That is, the Dangote company is available in the stock exchange market. If you want to determine the price of the share of a company that is not listed, is producing cement, maybe it's also operating, it may not be as big as Dangote, but it's a private company, it's not operating in the market yet. You want to buy a share of that private company. You want to determine the value of the share of that company. What they mean by market approach is that you go to the market and look for a company that is doing the same kind of business with that company, how much their share price is. That's what you will use to determine the share price of this company. Although adjustments will now be done because of the risk involved in the private company. We use that more. This topic, fair value, is better understood when we study business valuation techniques in strategic financial management. But the market approach here is that you use the price of a similar asset in the market to determine the price of the one you want to buy that is not available in the market. So it is a valuation technique that makes use of a quoted price of similar or identical or comparable item. When a quoted price exists for an identical asset or liability, it should be used without adjustment, except in circumstances under level 1 input. We'll be learning about level 1 input shortly. Then we have the income approach. There are 3 approaches that we use in determining that we use as evaluation techniques. One is what? Cost approach. Second one, market approach. Third one, income approach. For income approach is a valuation techniques that converts future amounts, that is the cash flows, to a single current amount, the discounted amount. The fair value measurement is determined on the basis of the value indicated by current market expectation about those future amounts. So if we want to use the income approach, okay, if we keep this asset, we want to determine the fair value of this asset. How much can this asset generate for us if we keep using the asset in the future? To the end of this. So for instance, we have a vehicle that has a 3 years useful life remaining. We want to determine its fair value, and we want to use the income approach. We use that if we keep using this car, how much net cash flow can this car bring us till the end of its useful life? So we now say, okay, this car can bring us to 200,000 every year for the next 3 years. So 200,000 in 3 years is supposed to be 600, but that is not how it's done. For value in use, we will now discount those 200,000 every year to the present value. Using the rate of interest in the market, we will discount it using our normal table. Year 1, discounting factor. Year 2, or we can use the annuity factor to discount it for those 3 years. Whatever figure we get is going to be the fair value of the asset using the approach. So the income approach are used for measuring fair value. The approaches are the present value techniques, the option pricing model, and the multi-period excess earning method. But what is majorly used under this standard for this level is the present value techniques. We will see that. So we move on to what we call the fair value hierarchy. We will treat some examples after this so you can see some of the things we're talking about. Fair value hierarchy. Ifrs certainly establishes a fair value hierarchy that categorizes into 3 levels as follows. 1, level 1 input, level 2 input, level 3 input. What is level 1 input? We want to look at the hierarchy of determining fair value. The hierarchy. It is when the first one is not available that we use level 2, and in the absence of level 2, we use level 3. Level 1, these are quoted prices in active market for identical asset or liability that the entity can assess at a measuring date. Now, we are dealing with what we call the financial assets now, our financial liabilities. For level 1 input, the example I gave earlier about Dangote company and a private company and determining the amount that the price of a private company is using the quoted prices of a similar company. Similar, you can see the word there. A quoted price for an identical or similar asset or liability in an active market. That's level 1 input. But in the absence of level 1, then we go to level 2 input. These are inputs other than quoted prices included within level 1 that are observable. So if we want to measure a company that is producing cement, we want to determine how much the value of their share should be. We first look at the market. We see Dangote. We see the price of Dangote in market. Then we now come and put in other consideration, considering the risk involved in a private company. One of the risks involved in a private company is that once you buy their shares, you are stuck with it. You can't easily sell it because the shares are not publicly traded. So once you enter into a private company shares, you can't easily sell it, except you want to sell it to the existing shareholders. And if they are not willing to buy, you are stuck with it. That's one risk that you will now be putting into consideration under level 2 because of the risk of not being able to sell. If it's a public listed company, you can buy share in the morning and sell in the afternoon. There are always ready buyers and ready sellers. because they trade shares on the floor of stock exchange daily. So other factors that will now be affecting the share after taking the quoted prices is what we call the level 2 inputs. It includes quoted prices for similar asset or liability in active market, quoted prices for identical or similar asset in market that are not active, that is, inputs that are derived principally from or corroborated by observable market data by correlation or other means, that is, market corroborated inputs. Inputs other than quoted prices that are observable for the asset liability, for example, interest rate, interest yield curve. All these are better understood under SFM. Observable at commonly quoted intervals, implied volatilities, credit spreads. All of these are inputs. Okay, if I buy these shares now, if the rate of interest go and change, and how do I measure? What do I determine as the fair value? What becomes the value of the shares? What becomes the condition of this company? All those other considerations will be put into level 2 inputs. So after determining level 1 inputs, quoted prices, you now consider other implications that can affect that private company, and then you put them into consideration. These are what we call level 2 inputs. Quoted prices, level 1, level 2, other factors other than the quoted prices. That is, these are inputs other than the quoted prices. Inputs other than the quoted prices included in level 1 that are observable. These are observable inputs, but they are other than the quoted prices. They are the inputs in level 2. Level 3 inputs, unobservable inputs. Unobservable inputs should be used to measure the fair value only when relevant observable inputs are not available. So unobservable inputs are inputs you cannot observe. They are not, you don't have relevant input relevant observable input. You use the unobservable input. For instance, when there is little, if any, market activity for the asset we're talking about, there is little market activity for it. Maybe the company is producing something that is not common in the market, and then you can't find the quoted price for it. Then you now begin to use assumptions. It is at this level you use assumptions. You can see, however, unobservable inputs, when you should reflect assumptions that market participants would use when pricing the asset and liability. It is based on assumptions. Oh, if I buy this share now, assuming this is not done, because you don't have facts on ground, so you do guesswork. It is when you are done with level 1, level 2, that level 3 is permissible. If information regarding the asset is available in the market, you use level 1, and then you make adjustment for the level 2, the other observable information that is available in the market. And it is when you are not satisfied, that is the asset you want to measure does not satisfy all of those inputs, that you consider level 3 input. So let's take another example here. I'll take this example to the worksheet. Okay, let me zoom it. Maybe we can even answer it if it does not require working. Let me zoom it if it does not require working. It said the International Accounting Standard Board, IASB, aims at enhancing the guidance available for assessing fair value in order to increase consistency and comparability in fair value measurement and related disclosures. To this end, fair value measurements are categorized into a 3-level hierarchy based on the type of inputs to valuation techniques used in IFRS. IFRS uses the term principal and most advantageous market. Required. What are the fair value hierarchies? That's what we just studied now. It's 3 marks. Let's go back and you see it again so you can connect it with the questions that they give us. Okay, so we still have it here. We have the issues. Okay, it's in the slide. So let me just scroll back. That's the answer. Let me put it back here. The fair value hierarchy they are asking us to answer is what we have here. Level 1 input, level 2 input, level 3 input. And you just give brief explanation on each. These are quoted prices in active market. for asset and liability that the entity can access at a measurement date. Level 1 input, you are done. Then you go to level 2 input and say these are inputs other than quoted prices included in level 1 that are observable for asset and liability either directly or indirectly. Input other than level 1, other than quoted prices in level 1. And then you go to level 3 input. These are unobservable. The level 1 and level 2 are observable. Level 1 is quoted, it is standard. Level 2, observable, but other than the quoted. Level 3, unobservable inputs should be used to measure fair value only when relevant observable inputs are not available. So level 2 usually was their assumption, they are unobservable inputs when you should reflect the assumption that market participants will use when pricing the asset and liability. That's the answer to that question that we are dealing with now. So let me move on. So they said distinguish between principal and most advantageous market. We have said that principal market is the market where the highest volume of transaction regarding the asset and liability takes place. And the most advantageous market is used in the absence of principal market. Most advantageous market is determined as a market that gives the highest net price received, the highest amount that can be received when there is no principal market. So for most advantageous market, we take the selling price, less transport costs and less transaction costs in determining the most advantageous market. So that's it. As simple as that, that's 5 marks. Then B, it is important for entities to understand and properly classify financial instruments. This is because some financial instruments may be features of both debt and equity, which can lead to inconsistency in reporting. To this end, financial reporting standards above provide guidance on the difference between financial instruments classified as equity and liabilities. With relevant example, distinguish between liability and equity under IAS 32 financial instrument presentation. We have treated this. Please watch the video. You said distinguish between liability and equity. The financial liabilities are debt instruments, and we can also have them as convertible instruments, compound instruments. Equity, that is distinguish between liability and equity, and it's 7 marks. Can you imagine? Equity is the owner's residual interest in assets, and they include shares, share capital, share premium, retain any and every other reserve that the organization can have. And how they are presented, don't forget that liabilities, for financial liabilities, they are presented under long-term liability, non-current liabilities, while equities are presented under the equity line item. That's simple. That question seems very simple and cheap, and it is 7 marks. So please watch our video on financial instruments to acquaint yourself with relevant information there. These are ICANN past questions. I will brought them here as an example under this topic this morning. Sorry. I'm trying, because I zoomed this, I don't want to go through the stress of taking it to worksheet, except it requires calculation. Okay, this one requires calculation. So let me take this one to the worksheet. Let's go to the worksheet and treat this one there. So we have a worksheet. So now, in the worksheets, let's treat this question. Let me find a place to position the question so we can treat it. So the last one we worked on. So we have the question there. So the management of Tolo Limited are considering the sale of an item of plant and machinery. The machine was acquired a few years ago and will be replaced by a new modern machine which is currently being manufactured. The management of Tolo intends to sell the machine as soon as it takes delivery of the new machine, which is expected to be after the year end. Management is currently actively seeking a buyer for the existing machine, while an appointment has been booked with a service center to refurbish the machine prior to its sale. The machine is carried in the book at 2.45 million, which approximates its fair value. The current machine is being marketed to potential buyers at 5 million naira. Management has classified the machine as held for sale. Not quite okay. Now this is not okay. I'm coming. Let me look at the requirements. Okay, the requirement is what determines. Okay, because that's another standard they are mentioning there. Okay, it's part of the what we're talking about. Management has classified the machine as held for sale under IFRS 5, non-current asset held for sale and discontinued operation. A new product is currently being developed internally by the technology team at Tolotolo. The product is expected to be completed in 4 years with users' acceptance lies. The management of Tolotolo are of the view that production phase will be 5 years' time. Tolotolo owns an accessories used in the agricultural industry, which will be sold in any of the two markets as follows. Then we have the two markets are here, market X and market Y. Sale price 65, sales price 625. Transport cost 50 naira. Transactions cost 75 naira. Net amount received 525, 550. Sales frequencies 5,000. Sales frequency 5,000 times. This is 1,000 times. Sales volume, that is the value. This 850 million. This one is 50 million. Required. Using the information about discuss whether the item of plant and machinery classified held for sale, item of plant and machinery can be classified as held for sale. That's under another standard. We'll deal with that standard. We want to deal with the one that has to do with fair value. A significant amount has been incurred in the current year on the development of new product by the technology team. Advise how the amount incurred should be treated in the year-end financial statement. Okay, I can quickly explain the answer to this, even though we have not treated the standard. But the last one is the one that actually affects the standard we just finished. Determine the fair value of the accessory in accordance with IFRS 13 fair value measurement. Now, in determining the fair value, we must determine it in the principal market. And principal market is the market that has the highest volume of transaction. So when we look at the sales frequencies here, we see that market S is the principal market. It has highest volume. This one is 1,000 times frequency. This one is 5,000 times frequency. So where is the principal market? Market S. So fair value is determined in market S. But what is the fair value that we are going to use? What is the fair value? Because the question says determine the fair value. They did not say we should determine the market. They said we should determine the fair value. So we determine the fair value in the principal market, and the fair value will be the sales price minus transaction cost only. Therefore, minus transport cost only. Transaction cost will not be taken into consideration. Therefore, what is the fair value? The fair value is 600 naira. It's as simple as that. There's no complex calculation. And the answer is 6 marks. The answer is that they have 6 marks to that question. Just know where the market, the principal market is. But if there is no principal market, then we work with this net amount received. You see that the net amount received here is higher, 550. So market Y will be the most advantageous market. However, the fair value will still be 575. We will only give consideration to transport cost. So if we don't have this information we have there related to sales frequencies, and we just have this net amount received, then we will know that there is no principal market. Then we will work with the most advantageous market. But as it is now, it is clear to us that there is principal market, and it is in the principal market you determine fair value. It is only in the absence of principal market that you use the most advantageous market to determine the fair value. So the principal market is market S because it has the highest volume of transaction, and the fair value is 600. That is sales price less transportation cost. However, let me quickly help with the answer to this question. Discuss whether item of plant and machinery can be classified as held for sale. So let's go back to read the question about the plant and machinery again. So I want to quickly read it. The management of Total Limited are concerning the sale of an item of plant and machinery. The machine was acquired a few years ago and will be replaced by a new modern machine which is currently being manufactured. The management of Total intends to sell the machine as soon as it takes delivery of the new machine, which is expected to be after 3 years. Management currently actively seeking a buyer. Management is currently seeking actively seeking a buyer for the existing machine, while an appointment has been booked with the service center to refurbish the machine prior to its sales. Now, this presents a conflict. Under IFRS 5, non-current asset held for sale and discontinued operation, an asset is only qualified to be classified as held of sale if the decision has been made by the management that we want to sell this thing. They have concluded. 2, they are actively seeking a buyer. They are looking for who will buy it. And 3, the asset is no longer being put to use. They are not using the asset again. We want to sell this car, for instance. We have packed it. We have put label for sale on it, and we are looking for who to buy it. But look at the conflict in this question. The management intends to sell as soon as it takes delivery of a new machine, which is expected to be after the year end. Okay. They will receive the machine after the year end. So let me say, okay, they are actively seeking buyer. An appointment has been booked with a service center to refurbish the machine prior to its sales. So this presents a conflict. They have not actually classified it. They can't classify it as held for sale. Because as such, which is going to be, they are expecting to take delivery after the year end. They don't have a certainty about delivery after the year end. So the asset does not qualify to be classified as held for sale. That is it. Because there are conditions that must be met. They are seeking buyer. They have made a decision to sell, but they intend to sell as soon as it takes delivery. So it is when the delivery has not been taken, they have not received the machine they want to use. It means they can't classify the asset as held for sale, but they are still using it. They want to refurbish, they want to spend money on it to maintain it. They are still using it. So the asset does not qualify as asset to be classified as held for sale according to IFRS 5. That's the answer to this question. So the explanation to this is that for an asset to be qualified as held for sale, the decision must have been made by the management and agreed that we want to sell it. And no condition. It is not a conditional decision. The decision is final. Not that, okay, if we can get another one, we will sell it. That's a conditional decision. It is not, you will not be able to classify the asset as held for sale because the decision is conditional. 2, they are spending money to refurbish it pending the time of the sale. No, they don't have to refurbish it to sell it. So it means they are still incurring expenses on the asset. So the asset does not qualify as held for sale. Discuss whether the item of plant money can be classified as held for sale. No, it does not qualify because they have not decided on selling. The decision is conditional that if they can buy another one. 2, a significant amount has been incurred in the current year on development of a new product by the technology team. Advise how the amount incurred should be treated. So let's look at that amount incurred. They say a new product is currently being developed internally. This one I want to talk about is under IAS 38, intangible asset. The first answer is on IFRS 5, non-current asset held for sale and discontinued operation. So a new product is currently being developed internally by the technology team at Tolotolo. The product is expected to be completed in 4 years with users acceptance testing finalized. They want to complete the project in 4 years. The management of Tolotolo have the view that production phase will be in 5 years' time. So they just started this. They are developing it. A new product is being developed and by the team, the product is expected to be completed in 4 years. In 4 years with users acceptance testing finalized. So the development phase has not actually been met, and the management of the view that the production phase will be in 5 years' time. So as it is, the amount incurred on these products, okay, the standard IS38 says any amount incurred on research and development should always be written off as an expense in the statement of profit or loss for the period until the management becomes certain that the development of the product is visible. So from this now there is certainty. They said the product is expected to be completed in 4 years. It means that they are already certain that the completion, they are certain about the date of the completion. And the management are of the view that the production phase will be in 5 years. That is, they will have to put it will take 5 years for the product. And the management are of the view that the production phase will be in 5 years' time. The production phase will be 5 years' time. But the development is expected to be completed in 4 years. The product is expected to be completed in 4 years with user acceptance testing. So there is certainty. They have a level of certainty about, because the standard says if the management is not certain yet that the production will be successful, they should write off the expense in the statement of profit or loss. But as it is now, it sounds that they are certain about the dates that the production process will be completed. Therefore, they should capitalize it. That's what the standard says. So this question that says, what does the question say? The question says, a significant amount has been incurred in the current year on development of the new product by the technology team. Advise how this amount incurred should be treated in the financial statement. The amount should be capitalized as work in progress under the non-current asset is where we are going to be treating this amount. They will begin to capitalize it. It will no longer be written up to expense because they are certain. They already know that this thing will be successful. For example, when Apple wanted to produce phone, Apple is the first company in the world that produced a phone that does not have keypad, more than one keypad. Before Apple produced their phone, iPhone 3G, all phones will have plenty keypads that time. But when Steve Jobs, the founder of Apple, said, we want to produce a phone, and our own phone, we have only one button. The engineers and the researchers said it's impossible. The argument was serious and things like that. At the end of the day, they started incurring expenses on doing research on whether that is possible. So all the expenses they are incurring that time, the standard IS38 intangible assets says they should write it off in the profit or loss for the period because they are not certain that the product will be successful. But from the date they become certain that the product will be successful, they should start capitalizing it as cost of as an intangible asset in their financial statement. Intangible asset are assets that cannot be seen. The cost of that development phase, they should start capitalizing it from the date they are certain. So the clarity from this question is that the management is certain because they can put date. You can see the product is expected to be completed in 4 years with users acceptance testing finalized. The management are of the view that the production phase will be in 5 years. So in 5 years' time. So they will start producing. So the development will take 4 years. They are sure they will develop it and they will start producing. So that development phase has been reached. Therefore, the significant amount incurred during the year should be capitalized. Should not be written off as into the statement of profit or loss, should be capitalized as a non-current asset, an intangible non-current asset. So we have been able to answer this question. Let's go to other questions that we have. That standard, I quickly explain those two standards because we have not touched on them. There is so much in ICANN, but at least if you watch this video, you have an idea of what the standard says. IFRS 5, asset held for sales and discontinued operation. IAS 38. I hope we're still able to touch on that because of time. We want to do sufficient work on ratio analysis after taking one standard after this, so that we know that we have covered. ICANN syllabus is so wide, it may take time for us to cover. So we want to treat this question. This will be the last question we want to treat this morning on the standard we thought about today. So I will take this question to the worksheet because it has calculation in it. So let's go to the worksheet and work on this question, which is where we're going to end the class this morning after this question. So I'll take this question here. So we are in the worksheet, and here is the question. Let's quickly read through it and work on it. Let me zoom it down. It seems too big. Question 4a. Fair value is a market-based measurement, not an entity-specific measurement. It focuses on assets and liabilities and on exit, that is selling price. It also takes into account market conditions at the measurement date. In other words, the fair value measurement look at the amount for which the holder of an asset could sell it and the amount which the holder of a liability would have to pay to transfer it. Required. Discuss the view that fair value is a more relevant measure to use in corporate reporting than historical cost. This is a CR question. As it is now, the view we are supposed to express that it reflects, because it reflects the conditions of the market. Discuss the view that the fair value is a more relevant. So we first define fair value as a price, the exit price that is used on a price that an asset can be sold, or liability, the cost of transferring a liability at the measurement day. It's a more realistic value because it reflects the assumptions that market participants will use on a measurement date. So all these explanations are just explanations you have to make to justify the use of the fair value. Let me take you to where you can see your answer briefly. It's in the slide, so that you can be able to see literally what you are expected to write when you see that kind of question in examination. So let's go. Let me zoom this down. It seems too big. So the explanation you are expected to give under that circumstance is that the fair value is a market-based measurement, not an entity specific. It is therefore measured using the assumption. So when you say discuss the view that the market participant, the view, let me see the exact question from here again. It says, discuss the view that the fair value is a more relevant measure to use in corporate reporting. So the view that it is more relevant is explained here. It is more relevant because it reflects the assumption that market participants will use. Assumption that market participants will use when pricing the asset or liability, including assumption about risk. Consequently, an entity's intention to hold an asset or sell to or otherwise fulfill a liability is not relevant. It's not so entity's view is not relevant. Fair value is more relevant because it reflects the assumption that the market participants will use. It reflects the fact that the market participants will hold the asset. So because the market participants are the ones who have the assumptions which can either be observable, which can consider observable inputs and unobservable inputs as defined here. Those are the reason why it is a more reliable value to use. It reflects market reality, the assumptions that the market participants will use. That's how to answer the question. You just express yourself, justifying the reason why market fair value is more appropriate in that regard. So that's how to answer the question we just looked at. 2, they said, discuss the valuation techniques in fair value measurement in accordance with IFRS 13. Don't forget the valuation techniques. We have the cost approach, which is what also related to what we call the replacement cost, and it's usually used for tangible assets. We have the market approach, which uses the prices of the similar assets in the market, and then we have the income approach, which uses the value in use, that is the present value of the expected future cash inflow. Those are the 3 valuation techniques that is used: cost approach, market approach, income approach. We talked about it earlier. You can see it in the video. B, Bakatari PLC is a public limited company that is reviewing the financial value, the fair valuation of its asset in line with the provisions of our IFRS on fair value measurement. The company has assets that are traded in different markets and is uncertain as to which valuation to use. The assets have to be valued at fair value under international financial reporting standards. Bakatari PLC currently only buys and sells the assets in market C. The data relating to the assets are set below. It has only been dealing with this market. However, there is cost of entering the market. So we now have required, explain the 3-level hierarchy for fair value measurement. Don't forget the 3-level hierarchy, we did with it earlier on. Level 1, input, which considers the quoted prices. Then we go to level 2, input, observations other than the quoted prices. Factors other than the quoted prices are used under the level 2 inputs, and that can deal with changes in interest rate, the risk involved after the quoted price. Level 1 deals purely with quoted prices. Level 2 makes adjustment for the observable inputs that are other than the quoted prices. Level 3 is the unobservable inputs. That one is purely on assumption that market participants use. Those are the hierarchy. Level 1 is the first hierarchy, quoted prices. Level 2, factors other than the quoted prices that are observable input, and level 3, unobservable input. 2, discuss with relevant computation how Bakatari should value the above assets under IFRS 3. Now, from what we can see, you can see the volume of market units. Which market has the highest volume? Market A has the highest volume of transactions. That is the principal market. That becomes the market where the fair value is measured per time. The market where the fair value is measured per time. So we now look at, so we can see this is the principal market. It is in the absence of principal market that we look at the most advantageous market. Although they have access to this market, but cost of entering this market can also be determined. So the fair value will be 19 naira minus 2 naira minus, okay, the transaction cost will not be put into consideration. 19 naira minus 2 naira, therefore 17 naira is going to be the fair value of this asset. The relevant computation is 19 naira minus 2 naira. Because although they have access to market C currently, but there is the cost of entering other markets, and the market, the fair value that they should use should be the one in the principal market. Discuss with relevant computation how Bakatari should value this above transaction. The transaction should be valued using the price at the principal market. And the price is 19 naira minus 2 naira. That's 17 naira. It's as simple as that. That will be the cost per unit. The fair value per unit of this. Even though they said, the position says that the assets have been valued at the fair value under this standard. Bakatari currently only buys and sells in market C. They only buy and sell in market C. However, the principal market should be used because if according to IFRS 13, principal market should be used. So the discussion there is that It is only in the absence of principal market that we can use the most advantageous market. As it is, the principal market is used, so we will take the price of the principal market less the cost of entering the market, and then 17 naira becomes the fair value of this asset. So that's all. You can see how simple fair value is, and you can see the plenty mark that is attached to it. This is 10 marks here now. Just explaining the hierarchy and doing that simple arithmetic computation. So that brings us to the end of this standard IFRS 13. I will touch on several other standards. That's what we'll deal with now, and ratio analysis. A weekend will be dedicated to ratio analysis and the report that should be prepared on ratio analysis before the exam. And then we'll do standard in other weekends. And then we'll just believe that God will help us. We have spent sufficient time on group accounts, and our group account is loaded enough to help us pass our examination. If we can